Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, we are back again with another podcast.
Andrew, we are back again week in, week out, bringing lots of knowledge and hopefully some entertainment to our listeners and our viewers.
Yeah, absolutely. And what are we back with again today, Bills?
Andrew, it's time for another market wrap today. So talking about the economic data that has come out, trying to dissect it a little bit, sort of short, sharp, around what's going on to get a feel of the economic environment, particularly in North America, so the US, a little bit on China, a little bit on oil, and finishing with Australia.
Yeah, absolutely.
Andrew, take us in. What are we starting with?
Yeah, look, I mean, the last month or so, we've seen some conflicting economic data coming out. We did see sort of some bank policy changing in the Fed. And as a result, we also saw the stock market fall in the last month or so. But I guess the big one is some of the commentary that was coming out of the Fed.
Yeah, look, it was interesting. I mean, they're talking about rates staying higher for longer, and obviously this is around the inflation piece. But what this does, and without getting into too much detail, but essentially they're saying that bond yields are going to be rising, and they're going to be staying higher for longer, which puts downward pressure on the stock market, which is the reason why we've seen the stock market decrease. We'll talk a little bit about that in a sec. But there was some commentary in particular around raising interest rates to 5.5% by the end of the year. They're currently sitting at 5.25%. So another 25 basis points. We're recording this at the start of October. So we're talking not that long until the end of the year, another 25 basis points. So they're not where they want to be in the interest rate cycle. Obviously, that's because of the inflation data over there, but that puts pressure on the stock market through rising bond yields. Andrew, what have we seen on the stock market?
Yeah, so we've seen the stock market go down 5.18%. S&P 500 was down 5.18% over the last month. Now, that's a pretty significant drop in the stock market. So the stock market hasn't reacted very well to that news. And look, there's obviously more news than just the interest rate movement that'll impact the stock market. But broadly speaking, over in the States, we're seeing some negative reactions to what's been happening with the economic data out there.
Yeah, and that's a pretty significant drop. I mean, if you consider that the stock market, on average, the Standard & Poor increases by, about 10% per annum, you're talking about a loss of yearly average gains in 1 month's time. So it is pretty significant. And I think where this is ultimately coming from, like we've spoken about and what we've alluded to, is inflation is going to take longer to get back to their target range. So the commentary that's coming out of the Fed is it's actually going to take 3 years to get back to target returns. Now, I don't necessarily think, considering what we went through with COVID, I don't necessarily think that this is unrealistic and unexpected. It's just that when the initial commentary came out, we thought we'd be able to get it back down quicker. And we'll talk a little bit about that in terms of the impact in Australia and things like that as well too. But that also spills over into the labour market.
Yeah. I mean, look, we've still seen a relatively tight or very tight labour market over the last month or so. So what we are seeing is that businesses are still struggling to recruit and keep people. I think the Dow Jones estimate there was a decline of about 20,000 people that were applying for government handouts, which, I mean, naturally you'd expect that to be a good thing. So normally you think less people relying on the government, more people working, fantastic thing for an economy. Broadly speaking, when we're looking at that in the current environment of high inflation, what that means is more people are working, more people are employed, businesses are having to pay more for people. The entire story around that is inflation, and everything that we're trying to do at the moment is to combat inflation, and so it's further fueling that fire.
So essentially, we're just seeing a tighter labour force, which is what we're experiencing here in Australia as well too. And it's one of those things, getting the balance right between how many people in a population are employed versus how many aren't. And there's actually a sweet spot. So in this instance, while those numbers look good, it's lower than that sweet spot. So it actually puts the wrong type of pressure on an economy. Interesting news out of the States. Andrew, let's pivot into China now. China's been a really interesting one of late, simply because of what's happening with the property market. So we saw the largest property developer running into trouble over there. That still hasn't finished and played out. So we're still seeing that happen. But what's happening in the Chinese property market, and what's the government thinking about it?
Yeah. So, I mean, look, these are, we're talking about, some very, very early offshoots in this. So this isn't to say that everything's going to be fine in the Chinese property market or anything like that. But what we are starting to see is some of the early offshoots of potentially some easing in some of the declines of property prices. So recently we've seen property prices really taking a significant tumble in China. And apologies for my pronunciation for anyone, but Guangzhou, there was an announcement of some home purchasing restrictions in 3 regions being eased. So this is really a signal that there could be some loosening in other cities in China around some of the purchasing restrictions. And essentially what that does mean, or what that signals to the market, is if there's easing in restrictions in, purchasing of property, then really that's going to essentially start to, kickstart the property market in China and start to, move that from a negative direction to, either flat or positive. So there is some early signs that the Chinese government is starting to, really take a focus on stabilizing their economy.
Yeah, and I think one of the things that came out of China recently in terms of the commentary is talking about the economic growth that they've experienced as part of the bounce back out of COVID. And they were saying that they were obviously locking down their population for longer than everybody else, but where it's taken other countries, say, 12 months to come out of it, China's only about 6 months into that process. So they're basically saying, hey, don't look at us saying our economy hasn't kickstarted well enough. You need to apply the same lens and give us more time, like everybody else has experienced as well too. So the policymakers over there are paying a lot of attention to it, and they're doing whatever they can to try and make sure that they navigate their way through this. And what you were discussing before in terms of the change in policy around the opening of the regions, I think that makes sense. And look, hopefully that has the desired effect. Oil's been a really big one recently. I'm really getting sick of going to the petrol station and filling up for $2.20 a litre. But unfortunately, petrol is one of those things that's inflationary in nature, because if you're consuming fuel for things like work, you don't have the choice. It's not necessarily discretionary for a large portion of the population. And that there is not built on anything that, as in the price, is not really built on anything that we can do. It's how the supply is controlled from OPEC and how that's done overseas. So from that perspective, it's having an impact on global inflation, and not really too much we can do about it in terms of us here in Australia around our behaviour in order to change that on an economic scale. I mean, obviously, if you can cut that back from your own perspective, you can get some of the price down. But if you need it for work because you travel, there's not really much you can do about it.
But oil is just so significant in the inflation equation because its implications are so large. When you think about, a good that may be produced overseas, there's the manufacturing process that ultimately, requires oil in order to produce a good. There's the transportation costs in, shipping that overseas or shipping that to various countries. There's the domestic travel once it, got into a particular region. There's the fuel costs of moving it across different areas of that country. The implications of oil prices to inflation is massive, which is why people are really looking at that quite closely. And so a rise in oil prices is also feeding into the inflation numbers that we're ultimately seeing across the globe.
Andrew, we might pivot into Australia now. So some exciting news. We've got a new Reserve Bank governor, which is pretty cool, who handed down her first decision this week. But run us in, what are we seeing from an Australian perspective in terms of inflation?
Yeah, so August inflation was, we saw a re-acceleration after 3 months of slowing down, which kind of puts people a little bit on edge. Not to steal Billy's next point around interest rate movements, but fortunately we didn't see any changes from the RBA this month. The rising or the re-acceleration of inflation was semi in line with a global theme, and so we saw inflation come to 5.2% on a year-on-year basis. But whether that re-acceleration continues or not is going to be, I think, a big determining factor around what happens with interest rates in Australia.
Yeah, and on that point, look, yes, Reserve Bank Governor Michelle Bullock decided to keep rates on hold, which is not surprising. And it's not like we should expect that we're going to get a new governor and it's going to be completely different. Michelle Bullock was the deputy governor and she was working there for a period of time, so you could almost assume that they're cut from the same cloth.
And the decision is broader than just one person making that call, right?
Definitely the case. And it's the right thing to do. And if you look at the notes and listen to what they're saying, they're basically waiting for the data, and they're still of the opinion that the interest rate increases that have been made haven't completely washed through the economy yet, which makes sense. But once again, what is interesting, and I just think this is the Reserve Bank not necessarily hedging their bets, just being a little bit more cautious around some of their communication, because I think with Phil Lowe, it was a breakdown in communication around interest rate indicators in terms of where it's going to go in the future. But with the commentary, there may be another rate rise if the data tells us to do it. So they are just saying, hey, we're holding for now, but there could potentially be another one if the data tells us to do that. And I actually think we're going to see that until there's a clear trend line that we've got inflation heading into the downward trend consistently, heading to that target range. And I don't think we're going to see that rhetoric change until we've got inflation in place in between that 2 and 3% band for a period of time.
Yeah, and I think the expectation for most economists has really shifted in that regard. We sort of spoke to most economists at the start of this year or sort of midway through this year. A lot of people were expecting potential rate cuts towards the end of the year, whereas now we're staring down the barrel of potentially a rate rise before the end of the year, and no real likelihood of cuts until at least second half of 2024. So the expectation on when cuts will come into the market, if at all, is going to be far later than what most of the market expected, which really kind of also feeds into the share price movements that we saw over the last 12 months. Over the last month or so.
Yeah, look, the S&P 200 was down 4.57%, obviously taking its lead from the States. Similar sort of rhetoric that what we were talking about when we were discussing the US. When your cash rate or your inflation or your interest rate is higher, your guaranteed rate of return, so your treasury bonds are higher, you can go to purchase one of those without taking on, essentially, that's your risk-free rate of return, right? And from that perspective, so as an investor, if you're going to invest in the share market, you want a greater rate of return because you're putting your money at risk. So what it does, it actually puts downward pressure on shares and it makes it harder for them to perform. So if you're an investor in a really simplistic sense, you may say, I'm going to take it out of the stock market and I'm going to put it into a treasury bond because I'm going to get a fairly decent guaranteed rate of return. And what that does is it softens the market because there's less demand, and this is what we're seeing at the moment. So I think we're going to see some volatility in the share market for at least the next little bit until this continues to play itself out.
Yeah, absolutely. And I guess sort of in line with the US as well, we are still seeing a very tight labour market in Australia as well. That's expected to continue for a little while. So the RBA is not expecting unemployment to rise to about 4.5% till next year, which is, still a very low unemployment rate. But it's going to take a little while until we do see unemployment start to kick back up again. which is a weird thing to be talking about. I don't think that many people in finance have spoken about unemployment rising as a positive thing for markets, at least in almost any of my experience as an advisor.
Well, what's almost interesting now, we're going to talk about some retail data. And although retail data was up slightly, 0.2% year on year, there are indicators, and this is quite obvious, that's heading in the other direction, simply because interest rates and the cost of living are getting more expensive. So households are tightening up on their discretionary spending. It's going to be an interesting period heading into Christmas because we usually see a fairly big uptick in terms of retail sales with people buying Christmas presents and the like. We should expect that the retail data, we should expect to see that turn negative, I imagine, just based on the environment that we're in, which ultimately speaking is not great from a retailer's perspective, but it does mean that the interest rates are having the desired effect, which means people are spending less money, which should then lead to, as bad as this sounds, an increase in unemployment.
Yeah, exactly right. Some of the good movers in the stock market over the last month, obviously the energy industry was really a pretty big outlier and a big outperformer. So they outperformed really based on the back of some continued oil price strength, and really that's been the big aspect or the big part of the Australian stock market that has really kept that S&P 200 at only 4.5% negative.
Yeah, well, that's maybe the thing that's stabilising it at the moment. So, exactly. But yeah, energy costs right around the world are increasing. Obviously, the transition to green energy as well too. Some interesting stats came out about, and it's a step in the right direction, although it's minuscule. But there was some statistics around the amount of energy that's being produced via solar panels rather than coal in Queensland. And for the first time ever, it hit certain thresholds and things like that. So it is a step in the right direction. People are electrifying at an ever-increasing rate, whether it's their houses, whether it's their vehicles. And I think we're going to see that continued pressure on energy costs, and just our consciousness around where we source our energy from. And it's probably because it's a direct impact and it can be so expensive. We spoke about $2.20 at the at the petrol pump.
If you're filling up a 91.
if that continues, then people will just turn around and say, you know what, maybe it's time. My car needs upgrading. I am going to go to electric. So
yeah, or and this is sort of taking us potentially on another tangent, but just throwing in that I managed to have a holiday this year as well. But we were in Crete. What was it, a couple of months ago? Well, it's been 3 months now, and the cost of petrol in Crete was just under €3 a litre. So once you convert that over to Australian dollars, the cost is absolutely insane. And so speaking to people, they had already, because of that, transitioned from larger vehicles to smaller vehicles. They don't have the infrastructure to support electric vehicles or anything like that. But you do see that consumer behavior does change when consumers are pushed in a certain direction from a cost perspective as well.
Yeah, no worries. Andrew, well said, well summarised. Thanks for another podcast.
Thanks, Bills. It was always, as always, good to jump on and share some of our insights with all of our listeners and our viewers, and hopefully they've gotten a bit out of that. And if you have, please like, subscribe, and look forward to catching you on the next one.
Thanks, guys.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.